The jobs report for the month of April was just released within the last 24 hours. And this was shocking because the results were not what the people expected. So the economy, the US job labor market, has added 253,000 jobs in the month of April, which was far better than March. Because in March, only 165,000 jobs were made. And what surprised also the market was the unemployment rate went down even more in April. Listen, I don't blame you if you are, a little skeptical about these numbers. If you do take it with a grain of salt, who's gonna blame you? These guys in March had said that there were 236,000 jobs made, and now it's revised. When you revise that to 165, who can go back in history and just be like, oh, you know what? Our estimations and our data says this. A month later or two, you go back in time. No, we're just gonna change those numbers because now now if we say what really took place, well, the market isn't going to be as bad because, we have already manipulated the market. Anytime they want, they can really just revise past data because the market has already reacted to that initial data, and they can just go as far down as 30%. That's a bit much, y'all. Unfortunately, I'm not even going to touch on the credibility of these reports, but that's the data. That's their facts. That's what they said. They said it went from this to this, 30% difference. The market has already reacted to the initial data. And, with the new jobs report that just came out in the last 24 hours, we're going to be expecting the market to react a certain way according to this data. And what happens in June or a couple months down the line, you say, oh, you know what? We're going to change April's data. The market has already reacted during a banking crisis, during this is insane. All right, anyways, so overall, the unemployment rate has dropped from 3.5% in March to 3.4% in April. And well, the Federal Reserve also does expect that the rate of unemployment by the end of this year could approach 4.5%. Some estimates are as high as 5% unemployment by the end of this year. Getting from 3.4% for, the data of unemployment to 4.5% isn't that crazy. It's not that big of a stretch, especially when unemployment rates are starting to come out. For example, I'm going to give you, starting at a low percentage, working our way up to a higher percentage, a list of fairly known companies and how, what portion of their layoffs took place that has been released but hasn't yet. Well, maybe some have been calculated, some have not been taken into effect yet because it's still too early. But here's an example. So as many of you are well aware, there was a wave of layoff recently. And here are the companies. In addition to all the layoffs that took place last year, let's get into the layoffs that took place this year. And let me know down below if you've been affected or somebody has been affected by the layoffs of these companies down below. So we'll start off with IBM. IBM says that they're cutting 1.5% of their staff. SAP, that's a software company, is planning to cut 2.5% of their staff. Accenture is another 2.5% of their workforce. McKinsey, 3% of their total workforce. eBay has declared 4%. Pinterest and Dell are both 5%. Ernst Young said 5% of their US staff, and Morgan Stanley, 5% of their total staff. Spotify and Google are both cutting 6% of their global workforce. Rivian, 6%. Roku, 6%. Goldman Sachs, 6.5%. PayPal, 7%. GoDaddy, 8%. Sirius, the satellite radio company, 8%. Salesforce, 10%. DocuSign, 10%. Zoom, 15%. LinkedIn, 15%. Dropbox, 16%. Shopify, 20%. Yahoo, 20%. Coinbase, 20%. Opendoor, 22%. Lyft, 26%. Twitter has laid off like 80% or 50% depending on your source of information, but they're continuing to lay off people. And most of all, Virgin Orbit has laid off 85% of their entire workforce. So all of these have been released to the SEC filings or have been shared with the public as of this year, 2023. And this does not include most of the layoffs that took place in 2022. That includes Meta, to Amazon. So you'll notice a lot of the companies I've mentioned are in the tech sector. So even though those were staggering percentage in the tech sector, last year alone was roughly about 90,000 layoffs in the tech sector. This year, it's already 190,000 layoffs. And we're only in like the 5th month of the year in May. Well, it's gonna get worse. Even though it hasn't started yet, we do expect it to get into the economy. Because of the pandemic, that has created big disturbances in the labor market. And because of the lack of available labor or employment, because of stimulus checks as on top of the pandemic, a lot of companies were hiring. Actually, they were over hiring just because it was so hard to find workers. Work scarcity. Now they're laying off a lot of workers that they've hired. Now there are sectors outside of technology that are still short in labor, such as healthcare, hospitality, even teaching, especially teaching. Also in manufacturing, the demand for laborers is always increasing. We need more workers in the labor force, especially for manufacturing. So we can see that in different sectors of the labor market, things are trying to find that homeostasis. They're trying to balance each other out. All right, so now I'm going to cover the JOLTS report. Now, the JOLTS report is a monthly release that covers openings, hirings, layoffs, quitting, etc. This is released by the Bureau of Labor Statistics. So the JOLTS stands for Job Openings and Labor Turnover Summary. So the unemployment rate shows the supply of labor, and the JOLTS data shows the demand of labor. And that's why it's crucial to find the supply and demand and to look at both data. The May 2nd JOLTS report shows that job openings are actually declining. The JOLTS report in March has dropped quite a bit from February's job report. For February, it showed that there was 9.974 million job openings. It dropped in March to 9.59 million job openings as of March. And that's dropping from another January report that had 10.8 million job openings and 11.2 million before that in December. So yeah, it keeps falling. And that's just demand for labor. That actually is the lowest amount in the last 2 years for job openings. And since the job demand, for labor is cooling off, this will inevitably affect wages. Not only will wage inflation decrease, wage growth will also plummet. Now, I'm sure the Federal Reserve, the Fed, they will rejoice over this data, but the everyday, US citizens, statesians, we're going to be carrying the bag. So another metric to also take note of is the quit rate. The quit rate is the lowest it has been also in 2 years, reaching a low of 2.5%. So less statesians are quitting. I want to go back to the JOLTS data because the first sign that companies will be laying off people is actually when they stop hiring. That sort of is the canary in the coal mine. When companies are not hiring anymore, when they put a pause on hiring new staff, that's a leading indicator also to the momentum that there will be job losses. Now, this indicator isn't the same across all industries. Some industries are further along the process than other industries as well, right? So the JOLTS report for April, actually, the expectations going into it was 180,000 jobs would have been created. This smashed expectations, as we saw in the market rally on Friday. It actually reported 253,000 job openings were made rather than the expected 180,000. Now, this is huge. This is 41% above expectations. And that's why we saw a nice bounce on Friday leading into the weekend. Also, the forecast was that unemployment rate, instead of going to 3.5% to 3.4% as it did, the expectation was from 3.5% it would go up to 3.6%. And it went the other way. Now these figures, 3.5%, 3.4%, ladies and gentlemen, that's historic lows. Last time the US economy had an unemployment rate of 3.5 or 3.4 actually was like, 60 years ago? I think it was like late 60s it reached this part. Until before then, it always was higher. Late 60s, we're at that unemployment rate. That's pretty low. And that's why it's crazy. So in this April jobs report, we see that professional business services has increased by 43,000 jobs. In second place came healthcare with 40,000 jobs added. Then we have hospitality and leisure with 31,000 jobs added. And there's also social assistance that has 25,000 jobs added as well. US government hiring has rose by 23,000 as well. Now, economists are saying this was pretty impressive of a report, even though, the market labor is showing that it's robust on paper. But they've also mentioned that there was an increase in GDP ratio and a decrease in GDP alone. Yeah, that's what economists are saying, which essentially translates to when your GDP goes down, you have a weakened economy, right? So in case you missed the last few episodes, GDP in quarter one nosedived to 1.1 GDP for the US. So as we covered on Wednesday's video, the US Federal Reserve says that, the job market labor is still strong, even though there's tighter credit conditions. And the tightening of credit conditions have not stopped yet. They're just going to continue to contract. Now, you can say that, yes, there's some resilience in the labor market. And since the stock market was also very happy with these results, I want to give you my 2 cents on how this is all playing out. I'll be taking a look at the comments down below, so make sure to leave your thoughts down there. So let's not forget, how reliable is this information? Because, if they revise previous data that affects the market because the time has already passed, what's to say that won't happen again in a few months down the line when they say, oh, you know what, let's change April's data and let's lower it. The market expectation was better than anticipated. That gave a nice bounce, a nice rally to the stock market. What's to say that they won't revise that because they've already reaped the benefits of stimulating the economy through this, sharing of the sentiment. I'm just saying that I'm taking it with a grain of salt because I'm not 100% sure on how reliable this information is. Now, when they stop, revising previous month's data for a while, then I'll start buying into it. But we just had March revised down by 71,000 jobs. How do you just get rid of 71,000 jobs because of a misunderstanding? Especially when you're the leader of the economy and the fiat, banking system. You can't just do that. You can't just give us some sentiment as if it's real and then expect us not to perform on that information. And this is what the crazy part is. It wasn't just March information that was revised with 71,000 jobs, which is significant enough because it's 30% of, what you shared with us in the market. You also changed February's. They've revised February's job by 78,000 jobs. Ladies and gentlemen, they revised 71 for March, 30%, 78,000 jobs in February. After the market has reacted and people have, it's like it doesn't really matter to them. It's like this whole thing is Fugazi, Fugazi. So how are we even sure that the rate is at 3.4% today of unemployment when a couple months from now they might say, that was actually 3.6. Your expectations were right. And we didn't beat expectations by saying it was 3.4. You were always right the whole time. What do you think the market will do because it rallied off of misleading numbers? You don't think it'll go back to expectational levels? Right? If we exceeded and the market rallied, but at the end of the day, we didn't actually exceed later on down the line, you don't think that'll basically initiate a next level down? And what happens to the credibility of these institutions? Since these numbers are the lowest it has been since the late 1960s, I want to say it was like 69, where it was at 3.5% as well. That was the last time we were at these low rates for unemployment. I'm pretty sure their metrics of what is unemployed has also changed quite a bit, like what they did with the CPI situation. The change that they've made was that if people stopped looking for a job because they couldn't find a job, they just kept getting rejected or declined, and then they just got uninspired to keep looking, the Federal Reserve will say, you know what? Because you were looking, you're unemployed, but now that you stopped, you're no longer unemployed. Yeah, that's their definition of unemployed, is you have to still be looking for market. Because if you've been deflated away because there was no positions and you kept getting declined and you just want to time off, right? You just said, I've had enough. You were beaten down. Guess what? They'll say, yeah, you're not unemployed. That's how they fudge the numbers. Let me know if you consider that this is fudging the numbers. Or if it's like, hey, that's just what the definition is, and or you're going to fault the definition. So yeah, overall, this job report is a painting of the overall labor market. It's not a very good painting. It doesn't paint a pretty picture. And I don't think it's a very clear painting as well. There's a lot of problems with this painting, I'll just say. But yes, it is a painting, although not a good one, or one I would rely on. Listen, I'm not saying there's like the Great Depression is around the corner, right? All I'm saying is it's hard to believe somebody when they revise their words, not only by huge margins, like 30%, but by doing it consecutively for previous past, not even that long ago, just recently, right? And then the market just like, oh, I have some great news finally, right? And okay, by the way, we gave you the wrong misinformation by accident of the previous ones, but don't worry, this month is good. So we expect the markets to rally, because if we gave you the truth before, the market wouldn't have rallied. It would have probably nosedived a little bit. But now that we have a good reason of creating, being honest with you for job expectations, the market can rally and we will correct our mistakes that we intentionally did, but it was just transitory lies. At the end of the day, if you're skeptical, I'm not going to blame you. Overall, we have the JOLTS data is showing slowing demand. We have the GDP data showing that there's a slowed economy. Here's this report that shows a lot of strength and resiliency. Would I be surprised if they, next few months, they come back and revise this sentiment, this data that they're sharing with us? I wouldn't be surprised. Now, the Federal Reserve is expecting, and they have shared, that the rate of unemployment, according to definition and where we stand today, will be 4.5% by the end of this year. This is the same recession that will be mild in the back half of this year. So there's those two sort of expectations that we know the Fed will be expecting. And because they were saying unemployment will be 4.5 and we're going to have a mild recession by the second half of this year, the next 2 quarters, the market was expecting job rates to go from 3.5 to 3.6 unemployment. But here we are going backwards, 3.4. Yeah, the market expected this for a reason, because of this mild recession, 4.5 unemployment rate that the Fed has projected. But here we are, the data is saying something else. And then as they share us the data, they say, oh, by the way, the other 2 data that we shared for February and March needs to be revised to align with our expectations. So the thing with the labor market, if you're not honest and straight up with it, when things go bad, they go bad very quickly. Economists are saying that if this charade continues and we don't actually talk about unemployment rate and the labor market weakening, it's actually going to weaken significantly in the second half of this year, which is like 7 weeks away when that story plays out. These are the same economists that are also projecting that the Fed will pivot later on this year, where I don't believe the Fed will pivot. I think they will pause at 5.25. I don't think they will raise. I don't think they will reduce and pivot. The economists are not always right, rarely, if any. The Federal Reserve isn't really, it's really hard to project on how a lot of this stuff will go. So, we try to do our best with the information we have and try to use as many resources that we are comfortable and capable of using. So when these economists are saying that, in Q3, the Fed will pivot and that will boost the economy, I don't personally find that's going to happen, but that's what they're projecting as well. That will help with, the deterioration in unemployment, and the labor market will be a little bit more robust because of this, pivot that the economists are expecting the Fed will do. That will cause what we call a soft landing. And that's the overall outlook for job openings and the labor market as well. But that's just my opinion. I'd love to hear yours down below. Let me know. Thank you for watching. If you like, make sure to hit that like button. If you haven't subscribed yet, be sure to subscribe. And actually let me know down below what you think. I would love to hear from you. And until next time, bye-bye.